Hello and welcome back to season 3 of Financial Secrets Revealed, where we are meeting the experts. And today I am joined by former swimming champ, Olympian Australian Grant Hackett, who is now the CEO of Generation Life. Welcome to the show, Grant.
Thanks for having me, Amanda. It was good to join you.
Now, this is a bit of a change of pace from being at the pool at probably 4 a.m. every day to putting on the suit and tie and heading into the CBD.
Yeah, no, it certainly is. It's quite funny now, though. I was on the Olympic team or Australian swim team for about 13 years, and I've actually been doing this for longer now. I've been doing this
Wow.
for 15, going on 16 years. So I've been in financial services much longer than what I was even in my sporting career. So yeah, but everyone tends to remember your sporting career a lot more than working in financial services. So it tends to, you know, normally
Linger
take the
around
shine most of the time.
the glory days.
Correct, correct.
And it's actually interesting how many former swimmers in the Australian team have ended up in financial services.
Yeah, no, a lot of people. Kieran Perkins obviously been one of my rivals. He ended up at NAB. I always say I got to Westpac first, and I was in there before he was, so I won that one. But yeah, no, there's quite a few athletes that end up in the corporate world, whether that's financial services. My old roommate owns his own law firm, so a lot of my former athletic friends, even though people look at the very high profile people, because a lot of them make way too much money, so they don't do much afterwards, but a lot of the people that were kind of in that sort of second tier, like a lot of my friends that most people wouldn't know as a household name, are super successful in their relevant field because they learnt those disciplines from a young age in terms of how to be successful and apply themselves, and they just went into the corporate world or to business and have been super
Carried it forward.
successful. Yeah,
There's even a few ex-footy players actually that
yeah.
planners as well. So there you go. It must be the transition career to go into financial services.
I'm a big believer that you've just got to have a purpose. So whatever that is, it's not necessarily about money, but it's about you finding your drive and somewhere where you can set really clear goals and aspirations and have a good crack at. And so for me, if I don't have that, I'm a little bit lost as an individual, if I'm being completely frank. So yeah, I love being in business, love running teams, love trying to set big goals and achieve them. So yeah, it kind of aligns to my personality type, I think.
It's interesting when you're talking about having a purpose. I've had some retirees, especially single women, who've kind of retired and hung up the boots and then been so bored that they have to have something to do. So whether they go and volunteer at Lifeline or in the local bookstore or, just feeling like you've got a purpose and being helpful is just so important to, having a fulfilling life.
Oh, it's a big part of life, really. If it's not more than anything, it's probably the essence of life is to have a distinct purpose, something to drive in. We're here for, we say it's a short life, but it is a long time, when you're sitting here for 70, 80, perhaps 90 years in some circumstances. So to sit there idle the whole time and to get into the exit lounge too early, I don't think's a very good feeling. So to feel like you're actually contributing, whether it's just to your community or in business or, in some other aspect, I think is a really important part of life and also just your self-confidence and self-esteem as well.
Yeah, absolutely. Nice to be needed. So
Yeah, cool.
we're actually here to talk about bonds, which is
We
much
are.
more boring than life purpose. So now bonds in Australia sort of aren't the bright, sexy, share fund way to invest and have kind of taken a back seat for some years. So can I just get you to unwrap what is a bond and why they sort of fell off the radar for quite a while and are now making a comeback?
Yeah, it's quite interesting with investment bonds. So they do predate superannuation in terms of the structure. So the way I think of an investment bond, it's just another legal structure to invest through. So comparisons to that are things like, trusts, companies, your own personal name. But the one that's more closely aligned to it than anything else is probably superannuation. And the reason that's the case is because this is an after-tax paying structure. So we have a headline tax rate, maximum tax rate of 30%. However, normally the effective rate sits between 12 to 15% for a lot of our tax optimized series because of the way the investment bonds tax is more favorable than, say, a bucket company, which has a maximum tax rate of 30% as well because we work on revenue account, not capital account. So it's a structure that hasn't been as mainstream because I think a lot of people, when they think of saving for retirement, obviously superannuation is the most attractive structure out there. But, ironically enough, the changes to superannuation back in 2017 really brought this structure back into focus again. And so we really had to go out there, innovate in terms of what are the investment options that we can add to our investment menu, so we can cover all the asset classes and have multiple options within each, or construct your own portfolio within there. What do the pricing look like? What are the product features that we have? Because one of the interesting things about an investment bond is it's a great estate planning vehicle, because regardless of being a dependent or a non-dependent beneficiary, it's 100% tax-free on death. So there's nothing to declare to the ATO. So it's got all these great features around it, but there was a lack of innovation because super was so popular. 2017 changes brought it back into vogue a little bit more. And now with more super changes, you can see around that $3 million threshold, and obviously the double taxation for amounts above that, it's created a lot of interest in this space again. And we've gone from having probably 400 or 500 advisors doing business with us on an annualized basis, now growing to closer to 2,000 advisors per year. And that continues to grow every single year as we get the message out there and really re-educate, I think, the industry on investment bonds and how they fit into your sort of holistic wealth proposition today.
So you've touched on a couple there, but what are the main advantages? Like, so if somebody's going, look, I've got my super fund, I've got my investment property, little share
Yep.
portfolio, why would I take a look at bonds? What are the advantages?
Yeah, so some of the core features that would perhaps provide an individual investor some value would be, first and foremost, a tax arbitrage. So if you're paying tax probably above 30%, or in that sort of close to 30% range, given our tax optimized series is much lower, there's obviously that tax arbitrage. So that's one. Two would be estate planning. If you've got a high conflict family, if you've got a blended family, or
Who
if you want
has
to
high
carve,
conflict families?
it's,
Seriously.
it's, it's so it's pretty normal. So everyone should probably have an investment bond. Um, the other aspect to that, which is really quite interesting, is a lot of grandparents like to set them up to bypass a generation because their children could be divorced. So everything's fine at their level, but they want to look after the grandchildren. So this is a great structure to be able to do that through. It's actually creditor protected. So Section 116 2D of the Bankruptcy Act, if you want to have a look at that, bonds are actually creditor protected. So there's the asset protection side. Really, really flexible structure. So the way I like to compare this is that if you've set up an investment bond, you've got all of these tax advantages that you've built over time, and you want to transfer it to someone else, you can do that. And there's no CGT, nothing's crystallized within your investment, and there's no stamp duty for the receiving party. So if you had an investment property, obviously if you're going to transfer it just to another entity, even though you might be the shareholder, whatever it might be within that entity, you're going to be triggering those tax liabilities, which doesn't happen within an investment bond. So you've got all this flexibility, you've got estate planning, you've got tax arbitrage, you've got asset protection in there. So there's some of the core advantages or some of the value that you could be looking for and potentially utilizing this product for.
Okay, so there's different types of bonds, obviously. You can do bonds for minor children, you can do funeral bonds,
Yep.
investment bonds. Could you give us a really common strategy and a case study of where it's a
Yep.
really cool idea to go, actually, a bond would be the perfect thing for that?
So there's some awesome case studies that we've got. And of course, I'm not going to use any names as part of that, but we've had situations where we've had some really wealthy people that might have a child that's estranged, and they've wanted to leave the lion's share of their estate to, one of their kids instead of two of their kids. So we've had cases there where people have literally put millions of dollars in an investment bond to make sure, and had a binding nomination to that one individual, that one beneficiary, and that's it. In terms of some other scenarios, we've had a lot of grandparents. This is very, very common for us, which might set up an investment bond for, say, 50, 60, 70,000 for a newborn or a young child. The parents then will have, we have a regular savings plan. So they get direct debited every single month into that bond. And that will be used for a future use like private school fees once they get to high school, or even, a first home deposit. So that's a really common strategy. So you've sort of got cradle to the grave in terms of those two. The other strategy that is quite common is people on high marginal tax rates that, might be around 40 years of age, paying down the house really, really quickly, want to invest outside superannuation because they want to have some sort of transition to retirement, and they want to be able to do that really tax effectively. So they might necessarily, get into their early 50s and want to stop working, but they want to dial down their working hours and supplement that income tax effectively through an investment bond. So you kind of, the reason we're actually called Generation Life and we rebranded it is because we do have a value proposition for every single generation, whether that's a newborn. I've just had a baby a few weeks ago. I set up an investment bond for each of my kids to be able to pay for some of those future private school fees, which never get cheaper. So,
Look at you
I've done
walking the talk.
and then you've got all the way down the other end to, we have a lot of people that, obviously in retirement have amassed quite a bit of wealth, have some issues within the family, or want to be able to do something to one individual party that might have been, even charities. We've had people leave stuff to charities before that have amassed tens of millions of dollars in wealth, because you can leave an investment bond to any legal entity. And then, like I said, it's 100% tax free upon that. So we've had all sorts of scenarios. We've had really interesting family scenarios where people have had even gambling addictions and stuff like that. So, and they might have been a single beneficiary for some parents, and where they've said, well, we've got a thing called future event transfer facility where you can nominate how and when the funds are transferred. So if you only want X amount of dollars or X percentage of the capital amount that's sitting in there to be transferred each year, you can do that. And you can keep those restrictions on there for a certain period or forever, if that's what you want to do. So, it's those sorts of, I guess they sound like fringe cases, but I feel like I hear them quite consistently. And when I say consistently, I mean week in, week out, we get really interesting situations that we build our case studies around when we go off and do, presentations to large groups, to be able to solve what can be quite complex and intimidating problems, but we can solve them quite easily through the investment bond structure.
It's interesting, the estate planning side of it, because I have heard of cases where parents do have children with substance abuse issues, putting the money in their will and going, look, I only want them to get an income stream or
Yeah,
something along those lines. And the courts actually overturn it and go, no, they're your child, they're entitled. Even though your wishes were very clear and why, it's like,
yeah,
tough, they're an adult, you shouldn't have put restrictions. Whereas you are kind of ruling from the grave because it can't
yeah.
be overturned by a court when it's set up in a bond structure. So great idea for estate planning.
And also, even when it comes to things like testamentary trusts, of course, you've got trustee discretion in all of those things, where if you're setting up through a bond, it's not going through the estate, doesn't go through probate or anything like that. It goes straight to the beneficiary, and then the money's disseminated in the way in which you want it to. And there's not one of these that have ever been overturned. So you're doing it with absolute certainty, and you're delivering an outcome that you want to, given, some of the situations that we touched on, whether it's substance abuse, whether it's gambling addictions, whether it's, other factors within the family. Even if someone's too young, you might be leaving a lot of money to grandchildren. They're all aged sort of, 12, 10 and 7. And you go, okay, they can access those funds when they're 21 and they can access this amount per year.
Yeah.
And we can do things like where you can have a sort of what I'd call more trustee discretion through our joint signatory, where you can have someone where you trust, where if they do need a one-off, lump sum because, something unforeseen has taken place, as long as the co-signatory agrees to it, you can sign that off and actually, withdraw an amount if that's what the initial owner wants to happen. Otherwise, you don't have to do those sorts of things. So as we've gotten this feedback over the years, we've built the product features that financial advisors and their clients think are the best use of the structure.
So you talk about bonds being a structure, and we know superannuation's a structure, but people sort of still refer to, oh, my super's crashed or my bonds have gone down. What
Yeah,
impacts these? Because the structures actually don't move. They're just a way of holding the money. So how does
correct.
what you invest in impact your returns, and what are the options that you can invest in a bond structure?
Yeah, no, it's really interesting because people say, yeah, my super's gone down. No, your investment products in your super have gone down,
Yeah.
So, and that's why I always call it a structure, because calling it a product is actually not completely accurate. Like superannuation is not a product. It's a legal structure that you invest through that has a certain, set of rules and taxation and all that sort of stuff around it. So you're 100% spot on, Amanda, around that. But in terms of the investment options that you can have through an investment bond, very similar to superannuation, and in that sense, we continue to grow out our investment menu. We determine the investment products that go on there. So we currently have 69. That's across every single asset class, including all your diversified options, or your single section options as well, single sector options as well. So you can basically, according to your risk profile and what your risk appetite actually is, you can choose those underlying investments, whether you want to be super aggressive or slightly conservative or somewhere in between. All those options are on there. And as we get more demand for other investment options, we obviously add those to the menu over time, as long as they're credible investment managers and fund managers, whether that's globally or domestically, that form part of that overall suite of investments that you can choose from.
So I can either go all out gung ho into shares or keep it really conservative, depending on what I
Cash,
want
fixed
to do.
interest. Yeah, correct. So you've got all that choice on there. So yeah, it depends on where you want to go, where you want to take your investments. A lot of people that are doing it, say for their grandchildren, they'll normally go quite aggressive because it's a really long-term investment horizon. Where if it's probably for estate planning, you're probably not going to go much further than a balanced fund, maybe a 50-50 or a 60-40 or something along those lines.
So if I've put my money into a bond and I just hear, look, Nana's really unwell in the UK, I probably need 5 or 10 to run away and do some family stuff. Can I pull money out quickly, or is it stuck there? What are the rules around getting it back if I need it?
Yeah, it's one of the really interesting aspects of a bond. If you've set it up last week or 10 years ago or 20 years ago, you can take out the money tomorrow. So you've got full liquidity of those assets. So one of the interesting factors about the investment bonds, there's a lot of tax benefits inside 10 years. However, if you hold it for 10 years or longer, you maximize the tax benefits. So say in year 11, you're on a high marginal tax rate through your pay-as-you-go income. Your investment bond's worth, $600,000 or $700,000. It's had this huge amount of growth in it. You could take that full amount out, and there's nothing to declare to the ATO. Inside 10 years, there's a few nuances on the assessable amount if you do take some of the money out. Like I said, you've got full liquidity at any particular point in time. But you've obviously, if you've been paying your investments at a lower tax rate, you've got the compounding effect of that over the years. When you take a partial amount outside of your investment bond, the ATO looks at that as a portion of capital and assessable earnings. And like I said earlier, if you've been paying that 12 to 15% tax rate in our tax optimized series, which is about 20 of the 69 funds that we have on the investment menu, you always receive a full 30% tax offset. So you've got liquidity, you have tax benefits inside 10 years. After 10 years, you just maximize those. So one of the common fallacies when people have read about investment bonds is they think they have to hold it for this minimum of a 10-year period, or they're only going to receive benefits from that point onwards, which is not completely accurate. So it's one of the big differentiators between us and obviously superannuation. We have to wait for preservation age before you can access those funds.
So there must be fees. I mean, if you guys are going, look, these are all the items on our menu, like a super fund, each individual fund has its own fee.
Yep.
And then usually whoever the super provider is, they charge a fee to administer the fund. Does it work similarly with bond companies in Australia?
Yeah, it does. So what we provide is we're an after-tax paying product. So we do everything from, obviously the tax structure, paying the tax, obviously having an investment team. We build product features around it, all that estate planning stuff that I spoke around it. And the way the fee structure works from our end is we just have an administration fee, and it's a tiered pricing structure. So, 60 basis points is the absolute maximum, which you pay on the first $50,000 up front. And from there on, there's different thresholds. And once you have a balance in the multiple millions, it's actually free, the administration fee for amounts above that. So we changed that when we came into the business. They used to have a flat fee that was closer to 1%. A few years ago, we changed all that. We said we really want to grow the business. People that are larger customers or adding more to their investment bonds, we want to make sure they get looked after from a pricing point of view. So we have this tiered pricing structure that we put in place that were people obviously very pleased about. And then you've obviously got the underlying investment fee for the different managers that you choose. So they can be low as 10 basis points for a lot of your single sector options on there, or they can be much higher for an active manager where you think you're going to create that investment alpha with that particular manager if you believe in their methodology.
Cool. So we sort of touched earlier on the three different types of bonds. Can you run through those again? And who would be, I suppose, the average investor in each of those styles?
Yeah, so we've got our child builder bond. So that's for people that are usually looking for I guess an investment period where They would probably sit on it from a very young age, and then it would be distributed or to be passed on to that beneficiary between the age of 16 to 25. That's the way that product works, and it's got certain tax nuances, obviously within that particular product category. The next one is a general investment bond, which kind of covers, I guess, the broader spectrum, pretty much all investors. And it's got, again, it's certain tax sort of considerations around it that I've already spoken through quite a bit. You've got access to, all of our products have access to all the same investment options. And usually, the big chunky sort of bonds and estate planning pieces, and people are doing it for a large tax arbitrage because they're wealthy individuals, will utilize that particular product. And the last product that we have on there is a funeral bond. Now, the funeral bond, which sounds like a very morbid product to sell, but it's great for some of our more elderly investors that want to sort of have money to prepay their funeral and take that burden off the family. But also from a government entitlements point of view, from a Centrelink point of view, it's fantastic because up to $15,000, it's discounted on the assets and the income test. So you're able to access usually more of the age pension for a lot of Aussies, depending on what their financial circumstances look like. So there's a few nuances around that product, which are, further considerations. And particularly if you're a couple, obviously you can do that up to $30,000. And, taking out just one funeral bond, a lot of the case studies that we see, you can generate an additional $1,000 as part of your age pension for a lot of people, depending on those circumstances in terms of their financial assets outside, if they're homeowners, not a homeowner, all that sort of stuff that comes into the method around that and the considerations that that Centrelink actually have. So, yeah, they're the kind of three core products that you can choose from. And definitely what we call the general sort of investment bond, which is called Life Builder on our menu or through our PDS, is the main one that's utilised.
So the people who are looking at going to, what, I want to be buried in Botany Cemetery and overlook the harbour there or the ocean, I want to get a prepaid plot. Why would I get a funeral bond instead of prepaying a plot or going to a funeral home and saying, look, I want White Ladies or whatever the company is to look after me? Why would I get a bond instead?
So you can certainly go and do that. And if you want to get the plot and those things are consideration, you would absolutely do that. So it just depends on what really your objectives are. But if you want to be able to, select at that point in time or give that, empower the family to do that, depending on, sort of what's going on in their particular set of circumstances, the bond really does give you that broad sense of flexibility. And also the other aspect to it as well is that you're actually investing the money too. So you can choose any of those 69 options. So none of us really know when we're going to die. So none of us got that crystal ball. So you could be holding on to that asset for quite some time. And you would like to see some growth in that money and you want to see that money working for you. So that's one of the biggest considerations when you're coming through a funeral bond versus doing those other things that are prepaid. It's sort of more set and forget. And obviously you've got those government entitlements as well.
One of the other things I did here was sometimes like maybe the funeral home might go under or go bankrupt in the meantime and you could lose your
Spot
money.
on.
So that's a bit of an issue for people to consider too.
Yeah, correct. I mean, the fortunate thing about a life company, which we are, we're a life insurance company, that is, if we were to mismanage the finances of our firm, which might add, we have heaps of surplus cash and no debt and a very profitable business. However, if we were to do the wrong thing, we just get absorbed into another life company. So one of the other big life companies in Australia would just take over those investments. The only risk you have with us is the underlying investments that you choose. So if you're, going to do something like that and you think, I really don't want things to go wrong with that money, and to your point, Amanda, that business could have some risk through it, particularly if it's a smaller business. With us, you could go, I just want to go fixed interest, or I just want to sit it in cash, or I want a mixture of some of those assets. So I might go into a balance fund, so I get exposure to a few different asset classes. So you've got that ultimate flexibility and you've got that safeguard in there, the fact that you're actually with a life insurance company, which is quite material. And we have to hold a lot of capital within our business for all this sort of risk management that we have to do as an organisation.
Cool. Now, one of the great things that came out in Australia after the global financial crisis or the global recession, as other countries call it, was that the government's come out and guaranteed cash up to 250,000 with different institutions. So by putting it with you, do you still get the government guarantee? Does that still work for Aussies?
It doesn't apply within the life company because the way any life company in the country, and it's always worked like this, is they become the beneficial owner of the assets. So I guess we get, on the first $250,000 worth of cash, we do get that. All of our cash is only with the big four banks. That's only who we deal with. So not every individual investor will get that. However, you do get that security of a life company. And I sort of spoke through some of the nuances and benefits of that before. So, look, you don't get that, but a lot of the time, a lot of people aren't necessarily going to invest with us just to hold in cash. It's not usually something that we do. Most of our investments are deployed across, the other asset classes in there, whether that's anywhere from fixed interest through to the more high growth products. So, yeah, so you don't necessarily get that directly. And if you wanted to get that and that was really important to you, we'd recommend you just go direct to the bank and keep it in your own name and not do it through a life company.
Yeah, just have it aside, which again, you don't get those Centrelink benefits you were talking about either. So you miss out on, so you win some, you lose
Correct.
some.
There's pros and cons to everything, right? There's always a sort of compromise on one side or the other. And look, if you're going to invest through us and get exposure to one of the big four banks, considering how robust their capital, their what's called their tier one capital requirements are, and how much they all sit above that, I guess, financial crisis that we would have to be in. I mean, we saw how good they were in the GFC. Our big, and because of APRA, and we're regulated by APRA like the banks, all banks and life insurers operate under the APRA standards. But, it was remarkable to see in terms of market capitalization, so value of the institution. At one stage there, our four big banks were in the top 10 biggest banks in the world through the GFC, because all
Wow.
those other big banks just shrunk because of the exposure to all these risky assets and the CDOs as we know it today. So, in this country, you should feel very safe. That regulator has done a fantastic job in terms of the standards and the requirements and the capital requirements that those institutions have. So I always feel pretty safe if you've got your money in your bank with one of those, regardless of the government guarantee that's attached to it. A lot would have to happen. And I don't want to sound like I'm giving financial advice, but that's just the reality
Financial
of the situation.
Armageddon on the way.
Yeah, correct. It's sort of meteorite stuff. I think we need Bruce Willis for that one, because it would have to be very, very bad for us to find ourselves in a
And I don't
situation
think
to
we're
see
going to
him.
get much more out of Bruce Willis, poor darling, with his
Yeah, that's very
diagnosis.
true. But, yeah, we've maximised him. He already saved us
Someone
once. But
younger.
I think at the end of the day, if a big bank went into administration, your term deposit holders are the first ones that get paid out anyway as well. So, which is not, something that people would understand too much. Your equity
Mm,
holders are the one that really, carry the risk in the big banks.
yeah. I actually had a woman come to me a little while ago through the Cancer Council. I do the occasional pro bono job for them, and this lady didn't qualify but wanted to work with someone who was on that list. And she was terminal and received an inheritance from her parents in the not too recent past. And she wanted to set up ones. She had about 8 or 9 nieces and nephews and wanted to make sure that they all received an inheritance that they could get it on their 25th birthday. So they sort of ranged in age between, 8 to 18. Some of them
Yep.
from poorer socioeconomic backgrounds, and it was her joy that she could do that before she passed. So
Yep.
beautiful story that she was able to provide, for these nieces and nephews while she was still able to make those decisions. So there's some beautiful
Yeah.
stories that do come out. Are there others you've come across that have moved you when you've been putting all your case studies together?
Oh, it's funny. We've had situations where people with disabilities, but only mild disabilities, where they haven't been able to get the special disability trust and all the benefits that obviously come with that. Where parents have had dependencies, but grandparents have wanted to look after those grandchildren. That have these sort of mild disabilities and challenges in life, and we've kind of been able to structure things where they've been able to create, cash flows, but absolute certainty in the way that money is distributed and the management of that. And yeah, so we've definitely seen some beautiful outcomes in some very, challenging and horrible circumstances that people have to deal with, but being able to solve those problems for people that aren't necessarily in great situations, but people have been able to look after them and know that they can, sort of rest easy, and know that those beneficiaries are going to get looked after in the way that they intended, and no one can take advantage of them, which is a really big thing. And just the case study that you went through there, Amanda, we have a lot of families that have a lot of grandchildren. And it's funny, we've got one that's got over 20 investment bonds actually with us, and it's going to the grandchildren in all sorts of different periods. Some are getting it when they're 21, some are getting it when they're 25, and they've all obviously got different sets of circumstances there, and it's quite remarkable how the investment bond can solve for all this sort of stuff. And yeah, you can get that guarantee. And we've had situations where people have worked with charities their whole life, and they actually want to leave a material amount of money. They've held that with us. We've been able to distribute that at points in time. We've even had people come back to us and say, you know what, I actually want to give the money to the charity now whilst I'm alive, and taking it out and gone, being able to do that. So, yeah, we get all sorts of situations there where, yeah, the social impact that people are trying to make is significant to them. And we're a structure that allows them to do that. Because a lot of we hear from clients that if they left that through their will, their kids would contest that. And all the research shows now that a charity doesn't even bother fighting that if the kids go to contest it, because they know they're going to lose that argument.
Yeah, I'd love to do a little bit of a deeper dive on the point of a bond staying outside the estate or the will. So if we can just unpack that a little bit more. So a bond can't be contested, but the will can. So how does that work for someone who's got a bond?
Yeah, so the way the bond works is that you can have binding nominations. So you can structure it as a non-estate asset. You can have it fall into your estate if that's what you want to do. But obviously, given the nuances of some of the situations that we've discussed, a lot of people don't like to do that. Or they want estate equalisation to go through their will, but leave that $500,000 out to their favourite son or favourite daughter. So,
We don't have favourites.
And they can do that with absolute certainty. And look, it's the reality is because it's an investment linked life contract, you're able to have those binding nominations. So that's why you can actually do that. And the great thing about it, unlike when it goes through probate, which can take months, and then if it's contested, they don't have to use their own money. You can use the money from the estate to challenge one another. So lawyers get really wealthy out of that. And a lot of the time, if it needs to go to court, there's another 12 months of waiting on top of that. So as a beneficiary, you could be sitting for many months or even years in some extreme circumstances to access those funds as they continue to dwindle down in the meantime. Where when it comes to an investment bond, if you're a beneficiary, you've got that certainty that you're going to receive the funds. But as soon as you give us a copy of the death certificate, and it doesn't matter whether this was set up yesterday or 5 or 6 or 10 years ago, as fast as we can get the money from the fund manager, which is just usually a few days, it will be in your bank account thereon. So not only do you get the certainty of getting the money, you get it quickly. And if someone wants to challenge that, they can do that. Of course, you can challenge anything. However, at the end of the day, you've got to fight it with your own money. You can't use the money of the investment bond, unlike if it goes through the estate. So, yeah, there is a lot of significant advantages to utilise the investment bond structure for estate planning purposes. If you've got a slight bit of complexity or bit of concern about how your money is going to be distributed. Even there's some great case law in New South Wales that we've got that 74% of all claims, there is either a minor or major change if it's heard in court. And for amounts above 3 million, 100% of the time there is some sort of change to the way the estate's administered.
Wow. So if someone was kind enough to leave me a bond, but I didn't know about it, it's only been going for 4 years, I'm guessing I'm not going to get that tax advantage you talk about, whereas if it goes for 10 years, it's tax-free. So can I choose to leave it there for 10 years, or do I have to take it because they said when they die? How does that work for beneficiaries?
So there's 2 aspects to it. One is upon death, it's 100% tax-free regardless of how long you've held it for.
I don't
So
have
if you've
to
only
wait.
held it for 4 years, yeah, you're a beneficiary, nothing to declare to the ATO. So on the
Nice.
earnings that you've had in that particular investment. So yeah, it's phenomenal to be totally honest. And then, but if you want to keep holding that bond, through Generation Life, you can do that. So if it was at year 4 and you want to get to 10 years and beyond, and obviously you're going to be building up assessable earnings, hopefully if your investments are appreciating between year 4 and 10, we don't start the clock again. The clock just keeps going from year 4. So you've got two great opportunities to either take the lump sum and not declare anything, or maintain the investment and retain all the benefits that's been built up to that particular point in time.
Now, I've heard this bandied around with bonds. There's a 125% rule. Can you
Yeah.
explain what that is and how it works and whether it's worth putting more in or starting new ones? What's that about?
So the way the 125% rule works is you can put in 125% of the previous year's contribution. So if you put in $10,000, obviously that means you can put in $12,500 the following year, and that can obviously grow over time if you contribute up to that amount. You can contribute 1% or up to 125%. Now the reality is, if you stop contributing to an investment bond, 125% of zero is zero. So you can't contribute anything more to that particular bond. However, you can have as many investment bonds as you like. You can start off with as much as you like. There's no caps, there's no limitations or anything like that. Now, if you did want to, go over 125%, what happens is that you start that 10-year process to maximize that tax benefits again. So, whenever someone accidentally goes to do that with us, we have flags in the system to make sure to say, hey, do you actually want to breach that, and do you want to start it again or not? Oh, no, I didn't realize that's what was going on. What we find with a lot of our investors these days is they attach just a regular savings plan to it, where we just direct debit, X amount per month that goes into that. We also have auto escalation, so that escalates every 6 months if that's what they ticked on there, to direct debit a little bit more from that particular account. So they're always utilizing a bit of that 125% going along, and I obviously do that with my own investment bonds as well.
Yeah, great idea. So if I keep doing it and I'm right for the 10 years and I don't go over the 125, I'm all good. But if
Yep.
I ever go, look, I'm going to Europe this year, I'm not putting the money in, I either have to
Yep.
start another one
Mm.
or zero for the life of the bond up to 10 years. Yeah.
Yeah, correct. So once you get beyond 10 years, though, this is really interesting, and I hope I'm not complicating it for the listeners a bit here. But what you actually can do is, because you're in that tax paid status from 10 years onwards, you could take out some money and then put it back, the same money back in, and you've been able to keep that 125% rule going. Because remember, there's nothing to declare to the
Oh, you can
ATO
restart
once you
it.
get to that particular point in time. So it's what we just call capital recycling. So you're able to keep growing that bond. If you wanted to take the trip to Europe and you couldn't add any additional money to it, but you could utilize the money that's already in there, and then the following year when you don't go to Europe, you can keep adding to that investment bond and growing it in perpetuity if that's what you wish.
Nice. Now, are there any rules with the beneficiaries? Because superannuation is very strict about who can and can't get the money. And the SIS Act tells us that you have to be a dependent, you have to be a spouse, a child under 18, or there's some interdependency relationship. I can't just leave it to my favourite cousin. Does that
Yeah.
also work with bonds, or is it free for all?
Yeah, and it's interesting, just touching on the super side, with the SIS Act, your situation can change, right? So those people that were dependents all of a sudden become non-dependents, and you haven't updated your nominations there. And all of a sudden you've got this taxable portion in super as part of estate planning. With an investment bond, none of that applies. So it doesn't matter whether you're a dependent or a non-dependent, or you are the crazy cousin that you love and you want to leave a little bit of money to, you can do that, and it's 100% tax-free upon death. So you don't have any of those considerations or requirements to update things as the circumstances change, like you do with super if you're using that as an estate planning vehicle.
Cool. Well, I think we've just unpacked nearly everything about bonds.
We've pretty much gone through most of it, I think. So it's one of those things, to your point before, Amanda, that it hasn't been a mainstream product. There's obviously, a huge amount of profile around super. It's consistently in the media. People get it. It's the preeminent savings vehicle. There's super guarantees, so I have to contribute to it in some shape or form. Where investment bonds are kind of this structure that really has probably been underutilized for a few years now, but is really now starting to grow quite significant in nature. And We did, I think it was FY22, we did about $640 million worth of new money that came into the structure here. And 55% of that, the primary use was for estate planning purposes. Where
Makes
we
sense.
always thought the tax arbitrage would be first or an alternative or complementary to super, but it's been quite remarkable as we're seeing this huge amount of money over the next 30 years transfer from baby boomers from one generation to the next. You want to make sure that you've got the right setups, particularly if you've got complex family situations that you need to cater for. And you can't kind of hope's not a strategy, as we say, when it comes to estate planning. You've
And
got to get it
that's the
right,
truth.
or
Yeah.
you could be leaving your family a really bad situation, and you could end up fragmenting your family because money, unfortunately, is one of those things that people tend to fight over. And if it's a principle-based argument and they can use the estate to fight one another, they're not really disincentivized not to get into conflict with one another. So yeah, we're really working with a lot of financial advisors in the industry to work out, well, what are the best features that we can build within our product or structure to be able to help administer those funds, how and when and with certainty.
Yeah, it's interesting that they aren't as sexy in Australia, but you chat to advisors in other countries like the US and the UK, and bonds are a
Mm.
massive part of what they do in their
Yeah,
strategies. So, yeah, it's nice
yeah.
they're making a bit of a comeback. So, good
They,
stuff.
they are. There's not many things from the 80s that are coming back, but we like to think investment bonds is one of them.
Oh my god, I can get my crimping iron, my banana clip out again.
Shoulder pads.
Hammer pants, yeah. Oh, thank you so much for sharing all that with us, Grant. Really appreciate it. Any final tips or traps to share about people who are interested in learning more?
Oh, look, I think what's really interesting with us is we always say, look, if you want to manage your money right, get someone who's a professional in it. So we always recommend going to a good financial advisor that's got a great reputation that can help and support you, and ask them about investment bonds. And what we do with an advisor, if they ever come across a scenario that's quite complex, we say give it to our technical team. We'll do all the work around it, and then we can say to the advisor and their client, yes, the strategy works for the objectives that you have, or no, it doesn't. Because we're here for the long term, so we don't want to be doing deals that don't work. So if you find that you go, I can't quite get my head around it, but I want to know if it works for this, test it with us, do the work around it, and then if it works, we'll let you know if it does or it doesn't. So I think it's kind of one of those things, the more you utilize it or when you engage with it, you understand and get it, but that always takes a little bit of time.
Perfect. Thanks, Grant. Really appreciate having you on the show today. I'll make sure all the links to Gen Life and how to contact the team are all in the show notes too.
Yeah, fantastic. Thanks, Amanda. Thanks for having me.